Good morning, on behalf of myself and the team here at M&G Southern Africa, welcome and thank you for taking time out to join us this morning. By way of introduction, my name is Wasim Abrams. I recently started as head of retail at M&G Southern Africa, the local chapter of M&G Investments, a global asset manager operating in 28 countries, managing just over 8 trillion rands worth of assets on behalf of investors. We're excited to have you here today to join us for our first CIO Connect, a new series of roundtable events where our 3 CIOs of equities, fixed income, and multi-asset share insights into our thinking, positioning, and global connectivity. Around the table with me today, I have Ross Biggs, CIO of Equities, Sandile Malinga, CIO of Multi-Asset, and Gareth Bern, CIO of Fixed Interest. As many of you may be aware, just over a year ago, we shifted to a 3-CIO model, demonstrating our commitment to collaboration, depth, specialization, and showcasing global connectivity. In this session, we'll explore how each team is interpreting the current macro as well as market conditions, as well as the investment team's views around dislocation and opportunities they are seeing in the market. Additionally, we'll highlight how the team are collaborating both locally as well as globally with our colleagues abroad in making better investment decisions, serving our clients in an increasingly interconnected and complex global environment. Gentlemen, welcome. Let's start with a brief introduction around your area responsibilities. And maybe Ross, let's start off with you.
Thank you, Wasim. Yes, so my name is Ross Biggs and I'm the Chief Investment Officer for Equities here at M&G. We've got a team of 17 analysts and portfolio managers, and our responsibility, our sort of specialization and focus is on equity investments across Africa. So, we're seen within the broader M&G group as being the African specialists. We've been investing in South Africa, in the sub-Saharan African markets and across North Africa for a very long period of time now. We've got significant investments in South Africa and one of the largest African fund managers. So in South Africa, our sort of our house view equity portfolios would be feeding into the multi-asset portfolios that Sandile and his team would be managing.
Maybe I'll jump in and just say my name is Gareth Bern. I'm CIO of the fixed income business in M&G Southern Africa, and we look after the full suite or full range of fixed income assets across both South Africa and Namibia. So that ranges from short-term cash instruments all the way through inflation-linked nominal bonds, both sovereign and importantly credit. So that's credit is a strong focus of ours, always has been at M&G, both locally and globally. And what I'd also want to just highlight is that although our focus is predominantly Southern Africa, so I mentioned Cape Town and Namibia, over the last 5 years, we've developed a capability in Africa. And so actually we've expanded our focus into actually managing sovereign exposures across a number of African countries, much like Ross and my colleagues in the equity team.
Sandile.
Great. My name is Sandile Malinga, and I'm the Chief Investment Officer of Multi-Asset here at M&G for Southern Africa. I was going to say CIO, but my two colleagues said the full thing out, so I thought I'll just follow suit. I look after multi-asset, the multi-asset capability within M&G South Africa, and that effectively means we specialize in two particular areas. We specialize in setting strategic asset allocations, or SAAs for short, as well as implementing a tactical asset allocation program. So we also specialize in TAA. And really, I think, we're quite fortunate to have, Gareth and Ross's teams to help us in the management of our portfolio. So, as Ross touched on, we want to leverage the specialist capabilities within the group and leverage those in all the portfolios where they're appropriate. So, we have the two teams helping us pick which stocks and bonds to have in our portfolio. So, every member of the investment team has a role to play in our portfolios, and I think that's by its nature the definition of collaboration.
So just on that, the 3-CIO model, it's been just over a year. How has it felt working in a 3-CIO model in terms of comparative to what you historically dealt in?
Yeah, so I think if I reflect, and it's probably almost 18 months that we're looking at now that the three of us have been working together in our new roles. And I think the thing that stands out to me is just how much closer we've worked together as a team. So we'd worked together, all three of us have been with M&G for a number of years and obviously worked together. But really in the last kind of 12 to 18 months with our new roles as CIOs of our different parts of the business, I think as a collective, we've worked incredibly closely together. So both Sandile and Ross are seeing more of me, I think, than they've ever seen in the past, which is a good thing, I think, or hopefully that is a good thing. And I think the benefit for me has been just leveraging off kind of both their experiences and skill sets in terms of, in particular, managing a team. And I think what's important is, we obviously manage our individual teams, but as a collective, we're responsible for the full investment team. And I think that's the aspect that, if I reflect, I think we've really made a lot of progress on as kind of the three of us working towards the full investment team and making sure that we're making the best progress that we can in assisting us deliver results for our clients.
Yeah, I mean, I think that's exactly right, Gareth. If you look at our investment philosophy and process, it hasn't changed over the last 30 years. So the benefit of that is every year you're looking at how you can actually get better and improve on that philosophy and process. And I think that's been critical to the success of our business. I think when you're looking the sort of collaboration between us, I think what's very important is we don't think of asset classes as silos. So it's very important when you're considering an investment and looking for opportunities that you actually look across the continuum of asset classes. So, when you're looking at, whether you're looking at cash, bonds, property, equities, you need to see that as a continuum of risk and opportunity. And so I think that's critical. We've set up our business so that there is this constant collaboration between the asset classes.
Yeah, and I mean, if I can sort of jump in there, I think for me the really interesting thing about how we've set up the business and the way the philosophy actually operates in practice is because we have this three-layered approach. We focus on valuations. We don't make forecasts. We're long-term in nature, and there's this risk consciousness that permeates all of the teams. And if you, for example, to give you an example, if you invest within multi-asset, like I said, every single member of the investment team has a role to play, from the credit analyst to the quant analyst to the equity PM. And really, I mean, that I think is the secret sauce of how we manage money. And as Ross has touched on, the 3-CIO model, and as Gareth has touched on, has really just brought us closer together for the benefit of our clients. But it doesn't end there. It's not just in South Africa. This notion that we want to leverage the specialist expertise across the group is present even in our global portfolios as well.
Okay, so on that point of global, just into the next question. So we often speak about global connectivity and the likes of dealing with our colleagues abroad. Maybe show or give an idea of how that interaction works in relation to global connection, global colleagues across the globe, and how does that influence your thinking down here on the ground?
Yeah, look, I mean, COVID did something quite interesting for us. It sort of shortened the distance between people by leveraging technology. So, with the advent of Teams, I don't know if you remember, there was something called Zoom, Teams and Zooms, and being able to operate in the cloud really means that, the distance between, the physical distance between the different offices is not an impediment anymore to collaboration. So, we have obviously had a more than 2.5 decade relationship with our colleagues across the globe, and one of the things that I think certainly post-COVID we appreciated was how those specialist skill sets can play a role in giving us the best possible information and views on valuations of asset classes across the world. So in the same way, where we want the best people, the specialists and the experts within the group to focus on, the area in which they're experts and specialized, we do the same across the globe. So, we've got our global colleagues helping us pick global bonds. We've got our global colleagues helping us pick global stocks, for example. And we've also got our global multi-asset colleagues helping us implement this, tactical asset allocation overlay across the board. So it's quite a parsimonious construct. And, if you open the hood and you look in whichever office you're in, you'll find pretty much the same thing, obviously with slightly different local flavors. But, the M&G way is really trying to blend the best that we can and come up with a sort of best solution for our client.
Okay. So a bit of a devil's advocate here. So that all sounds good in theory. How does it actually play out in practice?
So, in practice, we have been attending what we call our Global Macro Forum for more than 2.5 decades. And really, from an asset allocation perspective, that's where all the asset allocators come together and try and address, not so much the day-to-day challenges of managing portfolios, but really to think about some of the more thematic, regime-y sort of questions. And it's quite unique to find people who specialize in something as nebulous as asset allocation. But as when you set your objectives, your SAA tends to account for most of your returns for long-term investors. So it makes sense to us to specialize in that. And I can touch on it a bit later, but we spend a lot of time all over the world with our colleagues, and that brings tangible collaboration benefits for all of us. And it's not just a sort of a one-way flow of information. It's a two-way flow of information.
Okay. Gareth?
Yeah, no, I think if you look at the equity market, the JSE equity market, I think you need to realize that as South African companies have become successful, they've invested heavily overseas. And so, if you look at the composition, and we've got a chart on this just showing, the significance of the revenues that South African companies generate offshore. But if you look at that sort of composition, what you realize is that it's not just about analyzing South Africa, it's about analyzing, seeing these South African companies in a global context. And I think it's very important to realize that. So although you want that sort of local knowledge, you also want that sort of global view, that global perspective. And I think that's very important when we're talking to our colleagues in London. We'll be talking about asset managers or insurance companies, and having that sort of global perspective, global insights from our London team is very, very important. And we saw that, when we started investing in Africa. So, if you look at a cement company in Africa, in South Africa, for instance, when we looked at cement companies in Egypt, in Nigeria, you actually realized that they were part of the same sort of sector cycle, and I think having that perspective, understanding companies within those cycles, and within that broader global context is very, very important, and can add significant insight into the investment opportunity. So we really see a lot of value of having that local knowledge, really understanding the African markets, but then also having that diversity of views and global perspective that really sort of enriches the debate that we have when we analyzing the investment case for a company.
Oh, and I think just to follow on from that, I think in my team, we look at how we engage with our colleagues around the globe. I mean, the obvious one is just with our emerging debt team, which is based out of London. So we're chatting to them on kind of at least a monthly basis, if not more frequently. They cover emerging markets, which South Africa happens to be one. And so there's a good relationship that we have with that team, in that we can connect to them on a frequent basis. We bring the local knowledge, so we're in South Africa, we're on the ground. I think that's important. They bring the foreign offshore perspective, so they're covering the global emerging market realm. They can bring perspective on how South Africa stacks up relative to those emerging markets. We share ideas, thinking perspectives, it's very useful as South African investors based in South Africa to get that global perspective. And likewise, as I mentioned earlier, I think they benefit from local knowledge from investors on the ground. I mentioned also earlier that we've started investing in Africa more broadly, in African sovereigns, and they have a similar interest. So that's another area that we're engaging with common countries across the African continent. And then if we just think, I also mentioned earlier our focus on credit within the local market. Clearly our colleagues in the UK have a very strong focus on credit. And I think we've always seen ourselves as very strong on the credit markets, both locally and in offshore markets. And that's an area that we've collaborated quite significantly. Within my team, we've had credit analysts spend time with our colleagues in London. And that's just a useful sounding board to look at best practice, understand what's happening in global credit markets, look at the processes and see what we can learn. And that's both ways. So we've got, where they're common issuers, we benefit from the coverage that's coming from the team in London. Likewise, we might be covering some of the local issues that are issuing offshore, and we can provide that perspective to them. So, I think that really is the benefit of being part of a global organization.
Okay, so boots on the ground, broader perspective, better informed decision making at the helm.
Yeah,
I take it. Okay.
but you have to make it worth everyone's while, right? So it can't just be us, schmoozing from our global colleagues. And Ross touched on it. We have local expertise that is very valuable for global investors as well.
Okay, so on that point, let's turn to markets. So Trump 2.0, a lot more heightened volatility, day to day, less eventful than it was a couple of years back, and a lot more eventful lately. What are the key drivers moving your specific areas at the moment? Maybe Ross.
Yeah, thank you. So, I think you sort of touched on Trump. I think, one of the critical things to understand when investing, particularly in equity markets, is the future is always uncertain. So we always getting surprised by events that that arise. COVID was a very good example where no one could have predicted that COVID would arrive. And I think when you structure an equity portfolio, you need to structure it knowing that the future is always very uncertain. We could have another COVID around the corner. Who knows? But when we put together our portfolios, we structure them in a way that takes into account or tries to take into account that uncertainty. So if you look at how we've done over this sort of particularly uncertain period with the tariffs that Trump has proposed, we've structured our portfolios in a fairly balanced approach. So to have some defensiveness and to have some companies which actually do very well if the sort of tariff noise dies down and the economy start to improve again. So it's having that ability to be able to take advantage of price movements is critical. So if you look at what we've done over the last quarter in equities, we've actually said that the relative price moves of some of the stocks have been quite significant. So a company like British American Tobacco has performed relatively well compared to, say, the South African banking sector or the South African insurance sector. So we've sold some of that defensiveness into the South African stocks, which have done. BAT's done relatively very well. Those banks and insurers have done relatively poorly. So, having that sort of defensiveness and growth in the portfolio, you can take advantage of opportunities. So I think we've done that. We've done that fairly well. I think maybe just talking a little bit about the sort of valuations that we see in the market. So, we've had a decade of a very strong dollar, and I think that's put a lot of pressure on emerging markets. It's put pressure on frontier markets, and you can see that looking at the African markets, you can see that particularly in Nigeria, for instance, where the sort of pressure of that strong dollar has impacted the currency and sort of put a lot of pressure on that market. And you can see in the valuations in Nigeria how significantly those valuations have come down over the last 10 years. So I've put a chart up that shows the consumer staple sector in Nigeria. So there we've got the market capitalizations in dollars of Nestle Nigeria, and then all the big brewing companies. So it's a significant part of the sort of consumer staple market in Nigeria. If you go back just over 10 years ago, the sort of aggregation of those market caps was over $15 billion. Last year, that market capitalization of all those companies got down to almost $500 million. So you can see, the dramatic decline that you've seen in the sort of value of those companies. So if you look at that chart, you can see in sort of 2013, from 2010 to 2013, the market capitalizations went from sort of just over $5 billion to $15 billion. That's 3 times. From that low of $500 million just over a year ago, that the company's market capitalizations now are up almost 3 times as well. So it doesn't feel like the valuations have gone up that much, but actually you've made a significant amount of money because valuations have been very good in those markets. And we still think valuations look very attractive in emerging markets, and particularly in those frontier markets, which have been under pressure for such a long time. And you've seen the markets giving up on those markets, and that's really where the big opportunities lie. Those markets might be up, but actually we think they could still go up 10x over the next 3 to 5 years.
Okay, Gareth.
Well, 2025 in the fixed income markets, certainly in South Africa, has been quite different from what 2025 versus last year in what we experienced. If we just step back and we look at last year and we look at nominal bond performance, for instance, you saw kind of returns north of 20% over the year, massive rally in bond yields, sort of back in the trend of global markets, which have had very elevated yields. We saw the big rally in South African nominal yields post the formation of the government national unity. All the kind of tail risk around potential political outcomes kind of priced out of the market then. You saw that rally come through on the kind of enthusiasm investors had for the reform process and that rally that took place. So, you saw bonds return, as I said, over 20%, but that's petered out, right? And so as we started and entered the year, nominal yields have struggled. And if we just look at the backdrop that South Africa has been facing, it's really a fiscal challenge. And I think we've seen that kind of those fiscal concerns come to the fore. And really, it's been, we've seen evidence of this if we just look at kind of the February budget or the non-budget, the budget that didn't happen, and the debacle around the various budgets that we've seen there. And all of that has placed a lot of question marks around, firstly, the stability of the government of national unity and the political ramifications of should that fall apart or not, and brought lots of questions as to, well, what does that mean for the fiscal outlook for South Africa? If you then kind of allied to that, you look at the global developments, so we were talking about tariffs and the like, that's just another risk event sitting out there, introducing uncertainty, causing investors to question, well, what is the impact on South Africa's growth trajectory on the back of that? And again, that filters into what's the prognosis for South Africa's fiscal situation. So you've got all these fiscal risks rising, and that's been the tail of the market, and we've seen a significant amount of volatility. I think what's interesting, if you just look at the market dynamics also, is that's on the fiscal side, but you focus on the monetary policy side, on the short end of the curve. Actually, that's been fairly stabilized on that side. If you just look in terms of interest rate expectations, the SARB has been in a cutting cycle, but it has paused. We've got elevated real yields on the short end, but inflation has been printing kind of below the bottom end of the target. Inflation's back to levels that we saw kind of in the depths of COVID on that side. So, inflation has not been a problem. That's has been an anchor on the short end of the curve. So with all this volatility and uncertainty going through the market in the start of this year, what you've really seen is a curve steepen quite significantly. And so if you look at how steep the curve is now, you'd go back kind of at any point in time, you've only really been significantly more steeper during the height of COVID. And that period where you saw the massive rate cuts and obviously the fiscal concerns come through. But that just talks to this dynamic in the market of short rates being held quite firm, but the fiscal risk being priced in at the back end. So how have we sought to navigate that landscape? So, if we think back to the start of the year, actually, I talked about how nominal yields had compressed quite significantly on the back of all the positivity. Relative to what we'd seen in offshore markets, actually that relative pricing had looked quite constrained. And it's allowed us to be quite tactical in terms of how we positioned our portfolios. So we took off risk on the back of that. With all the volatility we've seen on the back of the GNU debacle or the budget debacle and what we've seen with tariffs, that volatility and the sell-off in yields, we took advantage of that then to add some more risk back into portfolios. And I think that's helped us, certainly benefited clients from that perspective. I think we just talk about credit markets, which I mentioned earlier. It's a big focus of ours. The South African credit market has been, spreads have been coming in for some time. And the market's lackluster. It just hasn't been issuance, and it reflects the lack of growth in the economy. So that's been a challenge, I think, for all credit investors for a number of years. It's not a kind of this year phenomenon. We're talking over a number of years, is the lack of growth in the credit markets. On the back of that, you don't have sufficient supply and a lot of assets looking to enhance returns and looking to deploy into credit. So you've seen that reflect in where those spreads have come down. So I think important development has been the government starting to issuing floating rate notes, which were never there before. We found a lot of value in that issuance. And actually, we've become quite selective in terms of the credit exposures we're taking. We're actually finding kind of the government floating rate bond offering a lot of value. And that means that the hurdle rate for those credits to get into our portfolio is just so much higher. So that's what we've been looking at in the fixed income market or fixed income business over this course of the year.
Yeah, I mean, quite an interesting point that Gareth makes on the credit. A lot of the fixed rate credit is trading through government, so you effectively are not being compensated, or it's a negative credit spread, which is a return to a topsy-turvy world. I don't know if you remember before COVID, there was trillions of bonds trading at negative yield, real yield. So that just highlights once again. Ross touched on it at the beginning. The world is always uncertain. So if you look at measures like economic uncertainty indices all over the world, we are at levels that we haven't seen. Even we've blown past COVID levels. So that just tells you that things have been quite volatile. But it's not just levels of volatility that are high. It's policy uncertainty, which makes the environment significantly harder for us to navigate. On the tariff front, there's if tariffs. I mean, I think the number is the number of tariff changes since the beginning of the year in the US are over 80. So how are you supposed to make long-term capital expenditure decisions in an environment where you have no idea what the fiscal or industrial policy or even access to market looks like? To us, it's been quite interesting. It just so happened Liberation Day coincided with our quarterly catch up with our colleagues, and I was sitting in London, waiting for the headlines to hit, and then you get these, we'll call them unorthodox tariff calculations that came through, and it was it was quite comforting being able to sit with other people who some of our colleagues have worked at various central banks, and to sort of sit around the table and say, okay, this is clearly something unexpected, totally unorthodox. How do we think about this? What do we think this means for we tend to think about things in fairly structured ways. So what does this mean for real yields? What do we think this means for inflation? I mean, we've already come out of COVID with elevated levels of inflation. The average inflation has actually been much higher than it was between the GFC period and the pre-COVID period. So already we've been grappling with this issue of are we moving into a new regime? And typically higher inflation regimes tend to coincide with higher real interest rates, or definitely higher nominal interest rates. So the question is a nominal rate just going to be higher, or is it going to be a real rate, which then puts a significant pressure on risk premium all over the world? So in the same way that we're living in this topsy-turvy world of negative credit spread in South Africa, we're now living in this world where we're trying to grapple with this new regime, but actually there's tariffs being thrown in there. So Wasim, that's just to say there's always a lot on the go. And to sort of bring my waffle to a little bit of an end, what does this mean for for our clients. So, you can imagine we're sitting in London, and we actually had a chuckle, 3 years ago, I was sitting in London once again after the GMF, and Liz Truss went and tried to put in place practical applications of MMT. I don't know if you remember what MMT is.
Maybe for the audience.
Monetary theory, modern monetary theory, which was effectively the notion that you can continue printing money because if you can grow yourself out of it, the market's not going to care. We got a quick lesson in the fact that there are economic factors out there that put constraints on governments and what governments can do, and the bond market is typically the teacher walking around with the rod to make sure everyone doesn't forget that. And so we're sitting in London, Liberation Day comes, and you're seeing market spiking, you're seeing bond yields collapsing, and really to our minds, typically, the way we think about the world, if there's been a fundamental change in asset prices, it typically doesn't coincide with rapid price movements in the short end. Economic variables tend to change over medium to long term. So if we see rapid price movements in assets, we tend to think there's an opportunity there. However, tariffs are obviously a change in economic fundamentals. So, on the one hand, you've got the tension of actually these assets have collapsed. Should we be adding equities into this environment? We think some of emerging market equities are cheap. We think some developed market equities are quite expensive. Should we be leaning more into that? Or should we actually hang ten and try and assess what the impact of all of this is, and what do we think is going to happen to asset prices? And you can only do that if you're sitting around the table debating with colleagues who are experts in what they do. So we've been fairly tactical, as Gareth mentioned. We've been tactical in the bond space, we've been tactical in global bonds, been very tactical on the equity side. Given that we find some value in emerging market equities, we have traded some of those markets quite actively. So we've often been exposed to China when the price has fallen quite dramatically, and we've been managed to make some decent returns because we're able to sit and have a fairly constructive conversation about valuations and not so much focus on how do we feel about this, or do you think the Chinese Communist Party is going to come and confiscate your assets, for example? So that is effectively the bedrock of what's been going on, and I have no idea what's going to happen going forward. But what we'll do is try and stick to our knitting and collaborate.
So Sandile, maybe to pick on you, and off the bat, I mean, with all of these things going on, asset allocation, current positioning.
So we are. Thoughts? We've moved from being overweight emerging market equities quite a lot at the beginning of the year. We've brought that back as emerging market equities have outperformed developed market equities, and South Africa has been a sort of an echo of all of this sort of global price action. Within regional equities, we've been overweight China in some fashion, and we've brought that back as the market has rallied. We have sought to build a diversified portfolio, as Ross mentioned, of certain geographic exposures. So we've recently taken off some of our exposures in some other emerging markets. So Mexico has performed quite well. Brazil is continuing to perform quite well. Indonesia, or Thailand, or even Taiwan, for example, have been standout our performers. And currently we're around slightly underweight, given we've taken profit on some of those, given the performance on the bond side. We've been fairly tactical as well. So we were overweight duration at some point in South Africa, and we've brought that back a little bit as some of the yields have collapsed. And in global bonds, we we find credit spreads quite stretched at the moment. So we grossly underweight credit spreads, but we are overweight, developed market long bonds in the US and in Europe.
Okay. And then Ross, maybe also to put you on the spot there. I mean, as you mentioned, the house view equity is a feed into Sandile's multi-asset portfolio. Sector preferences, opportunities you're seeing in the market at the moment, more broad-based?
Yeah, so I think maybe just also touching on Sandile's point, one of the most important assets to look at in the world is the US bonds. So if you look at the 10 years or the 30 years, those bond yields keep on moving higher. So the 30-year bonds have just broken 5% pretty convincingly. So I think, in the back of our minds as investors, as equity investors, the hurdle rate has been moving up, and so I think that's the important thing that you've got to keep at the back of your mind. That hurdle rate is going up. That not only means potential higher interest costs for companies, but it also means a higher hurdle rate and discount rate for equities. And some equity markets have been making new highs on the back of those higher bond yields. So that's a bit of a sort of a conundrum in a sense. So in terms of your question about, what sectors look interesting, I think I'd come back to my sort of previous point about having a fairly balanced portfolio. So taking a sort of a more barbell approach where you can, depending on where valuations move to, you can actually take advantage of relative price movements. So, we think if you look at the South African interest rate sensitives in particular, you've been given some very good opportunities over the last quarter to actually increase your weight to those sectors. So sectors like the South African banks, we think look relatively attractively priced, very good dividend yields, and they're reflecting the sort of higher bond yields that we've seen in South Africa. So we think you're getting a very good return in the bank space, for instance.
Okay, so gents, lots of insight shared. Obviously, a lot going on in the market. And for our listeners on the line, we're sitting with 3 CIOs in our first CIO Connect. Make it real. What gives you the edge? Why this business?
No, maybe I'll jump in. I think from our side is a consistent investment process. A process, as Ross was referring to previously, that hasn't changed over the last 30 years. And I think it's that consistency that helps us deliver those returns. And so when we think about that, it's a focus on valuation that we're looking at, making sure what price are we paying for what we're getting. A very strong focus on avoiding the noise on the day-to-day basis and looking to the medium to longer term. And then importantly, I think across all of the asset classes, there's a very strong focus on risk control. And I think that's extremely important. It's not just about the returns that are on offer, but understanding the risks that those particular assets introduce to your portfolios and what the ultimate objective of the client is. And sticking to that has been the secret to success, certainly in our team. And if I just focus on that kind of consistency, and that we can just point to our high yield bond fund, bond unit trust fund, that's been the recipient of a number of awards recently, which is just really pleasing to see over kind of the longer term 3-year numbers. Really a really great outcome for investors in that fund, and that's replicated across our fixed income product suite. So it's just been really pleasing how that consistent focus on the process has delivered the end results for our clients.
Anything else to share?
Yeah, no, I think what, just following on from what Gareth is saying, I think, you're never going to see any of our portfolios shooting the lights out in any one year. I think, our focus is always on that sort of 3 to 5 year investment time horizon. And I think that's becoming more and more important. So, the markets are getting, with the sort of development of AI funds, you can see them operating in the, even in the South African market. Those funds are much more short-term focused. You're seeing, a lot more index fund activity in our markets, all trading at the sort of closing auction of the day on the equity market. And that's just telling you that there's a much more, I think, shorter term focus of a lot of market participants. And so I think the ability to continue to focus on that 3 to 5 year investment time horizon, I think that's where you can, potentially, or you can make a lot of money from having that long term focus. So I don't think we're ever going to be shooting out the lights out in any one year, but if we consistently, do much better than average over 3 to 5 years, you can see the performance of our funds tends to do very well.
Yeah, I mean, why M&G? I guess, for me, if I sort of think about it as, someone with a few rands to put to use, we have a consistent investment process, a solid investment process, a deep understanding through leveraging the specialist skills across the group of the various asset classes. We are long-term focused, so we tend, obviously we're human, so we do get influenced by events, and I think that's part of the secret sauce, where we are able to reflect on those and really interrogate whether the price action is fundamentally driven or if it's behaviorally driven. And because we focus on the long term, we use and leverage the tools that tend to work over the medium to long term. So we're very focused on valuations, we're very focused on understanding the various cash flows, the incidence of the cash flows, timing of cash flows, and how you discount those through time. We really spend a lot of time thinking about how to bring all of this information together into a coherent, risk-aware and risk-conscious framework, such that you are looking to generate consistent returns over time, not really looking to hit for sixes. In that way, you tend to want to have a long-term relationship with your clients as well, to walk the journey with your clients. And I think leveraging all of this in a fairly consistent process that's been through many, many different market cycles shows that this is certainly our best way of meeting client objectives.
Gents, thanks. Great insights shared. It's great to see that there's a shared discipline despite three individuals in the room around the way we think about asset classes, long-term returns, objectives and delivering for clients, as well as valuations, and in terms of how we think about risk holistically. With that, we've got some questions coming through on the line, and we'll take some of those now before closing our session. So we've got a question that's come through online, and it relates to gold, which is quite topical at the moment. Maybe Ross, this one's for you. What are your views? Our current positioning in the portfolio and outlook.
Yeah, I think that's a very good question. So I think gold's been very, very topical, and I think why it tends to be topical and sort of you get you have these gold bugs and people get very excited about gold. The problem with gold is it's very difficult to value because it doesn't earn anything. So you don't get a dividend from it. You don't get any interest yield from gold. So it's a very, very difficult asset to value. If you look at history, one of the sort of better ways to try value gold is to look at the real level of interest rates. So the higher real rates go, the more costly it is to hold gold because you're not earning an income. So I could be owning tips in the US relative to gold where I'm earning nothing. So if you look about 18 months, 2 years ago, that model started to break down. So we saw real US yields starting to move up, and yet gold continued to move up. And so we saw a big dislocation between that sort of real rates model and the gold price. And I think it's at that point we actually said, it's rather than saying, this doesn't make sense and, the gold market's wrong, you should always look at that and say, we've seen this dislocation, and what could be the reasons for this dislocation? And I think what we sort of saw was that there was a lot of central bank buying of gold starting up. So we saw, the Central Bank of China starting to buy big amounts of gold. And so, central banks, which previously had held very little of their reserves in gold, started to buy gold. And so, we realized that dynamic was starting to play out. And I think, probably one of the best decisions that we've made in the last 2 years is to actually have a decent amount of gold in our portfolios, because we saw this sort of dislocation happening and sort of understood that there could be something else happening in the gold market. Good. I think that's played out fairly well. So I think where things don't make sense, you actually need to sit back and say why is that the case, and do we want to take a very big underweight position to gold when actually there's something else is happening in the gold market. So I think we've done fairly well having a decent sized position in the gold space.
Okay. Another question that's just come through here, Sandile, for you. Global equities. So with the rand coming back slightly right now, is now a good time to be going offshore. I think two parts there. I mean, obviously currency valuations, and then
Yeah.
secondly, I mean, valuations from an equity perspective. What are you buying abroad?
Yeah, I mean, it's always topical chatting about global equities. We need to say we are, neutral to slightly underweight in aggregate, and that is driven by a valuation assessment. So if we look at, our valuation slide, where we have, a range of global assets, from the left you've got cash, in the middle you've got bonds plus credit plus equities on the right hand side. Really, that gives you a sense of what your medium to long term returns are going to look like in real space, because you want to abstract from individual countries' inflation rates and try to get a sense of the real value of these assets. And typically, the higher the real return, the more interested we are, and the lower the converse holds true. And what we found certainly after COVID was the exceptionalism of US equities challenged the valuation view of them, because as they kept on rallying, the market is effectively discounting higher and higher growth rates in those earnings over time. And yes, you've seen delivered earnings growth being quite robust, specifically in so-called Magnificent Seven. But our job is to try and balance the valuation signal, the available information, whether that price action makes sense in the context of what's happening with real yields and the inflation regime. And so it's been very difficult for us to buy equities that are on first brush obviously expensive. So our approach has been to look for markets where the valuation is quite cheap. So I previously mentioned emerging markets. So you've got emerging market Asia, you've got China, you've got Latin America, and even in Europe there's been some instances where European equities have been quite cheap. And just moving away a little bit from global equities and focusing on South African equities versus global equities, it's been our contention that the valuation on South African equities is quite attractive. Yes, we're not growing the economy at 3 or 4% GDP growth rates, but you're still managing to get some pretty decent returns and pretty decent diversification from the regional spread of earnings. So when you're looking at South African equities, you're not really buying the South African GDP, which I think is a mistake a lot of people make. So just on the valuations themselves, when we compare them to their own history, South African equities are very cheap. When you compare them to global equities, so you can see on that slide, we screen very well. So the real return that you expected to get is quite interesting. So we've had this bias for cheap emerging market equities, cheap developed market equities. We've been underweight US equities. And really that relative value position has come into its own certainly this year. It's hurt quite a lot, but like we always say, valuations don't always work on the short term, but it's really of the medium to long term and this focus on long-term returns that has served us quite well. So our challenge at the moment is, yes, the rand is rallying, and 5% rally in the space of a week is a lot, but what do you buy? So we in order for us to justify that move, we have to satisfy ourselves that our bonds are expensive, which we don't think. Our equities are expensive, which we don't think. So the hurdle for putting in emerging market exposures in the portfolio is quite high. The hurdle for putting in developed market exposures in the portfolio is quite high. So yes, the rand has rallied, but it's come off a fairly low base, if you will. So it can still rally further if you believe in valuations of currencies. It's quite it's sitting quite on the cheap side. So yeah, I mean our preference is really for emerging market equities. It's for South African equities. It's for cheap developed market equities, and trying to stay away from expensive equities, and the US happens to be one of those.
Okay, so to sum it up, global equity is not off the table, but it's where you find value going forward.
Finding value, but it's in that relative value and picking the right
equity markets.
Okay, brilliant. So just in the interest of time, we've got quite a few questions still coming through online. We'll respond to those via a survey and an email that will go out post this webinar, which will include the presentation. I think, gentlemen, thanks for taking time out to join us. A lot going on in markets, a lot of considerations, a lot of insight shared, and I think a lot of things to digest for those on the line, as well as myself, in terms of a retail investor in the M&G Balance Fund equity, as well as the bond fund. So just to close out, just some housekeeping. For those on the line, we'll send out a short survey as mentioned. Please provide feedback. We'd really appreciate that to get your thoughts and insights around how we actually progress and give you more of the information you're looking for. And then this recording of the webinar will be on the website, www.mng.co.za. We'll also be able to find our latest publications, fun fact sheets, and various insights provided by the experts in the room. CPD certificates will be sent out in the next 2 weeks. And with that, thanks for joining us and taking time out. And to our CIOs, thanks for making the time to spend with us today.
Thanks, Wasim.
Thank you.